A wonderful day to you all. Welcome back to Nifty Sense. Today is Friday, January 9, 2026. If you looked at your portfolio today, it probably hurt. The Nifty fell 193 points to close at 25,683, and the Sensex shed over 600 points. But while everyone is talking about the 4.5 lakh crore wipeout in market cap, I am looking at the 307 stocks that hit 52-week low. Why? Because this is where the next multi baggers are born. Why the crash? Is it tariff tantrum 2.0? US President Trump has backed a bill allowing up to 500% tariffs on the countries buying Russian oil. India is caught in the crossfire. We saw Adani Enterprise and the NTPC lead the losers. FIS dumped 2,100 crore today. But here is the mystery. If the economy is in trouble, why did the United Nations just upgrade India's GDP growth forecast to 6.6% this very afternoon? There is a massive disconnect between the price on a screen and the value in the economy. Today, we bridge that gap. The noise versus the signal. Think of the Indian economy as a busy expressway. The tariff news is like a temporary toll hike announced for foreign trucks. It slows down the traffic for a few days. FIs or the tourists, they see the toll hike and take U-turn immediately, selling 2,100 crore today. DIs are domestic investors are the daily commuters. They know the road is still the fastest way to growth, so they keep driving, meaning buying the stocks. The drop in reliance on ONGC today is a reaction to the toll, but the structural demand for the energy remains unchanged. This is political dip, not a profit dip. Let's look at the real reason the Nifty is bleeding today. I'm pulling up the 48-hour overlay while the Nifty crashed below 25,700. Look at Brent crude. It has jumped from $58 to over 62.5. Why is this happening? Two reasons. First, the AI reported a massive 3.8 million barrel draw in US inventories, double what the experts predicted. Second, the geopolitical risk premium is back with a vengeance due to the unrest in Iran and the US seizing tankers in the Atlantic. For India, which imports 85% of its oil, this is a double whammy. The market isn't just reacting to tariffs, it's reacting to the fear that our current account deficit is about to balloon. Part 2. Let's deep dive into the green flags. Stock number 1, Asian Paints, the inverse breakout. Look at the screen. Normally, these two charts should be moving in opposite directions. Crude oil just spiked 4% to cross $60 per barrel today. Usually, that's a red flag for paint companies because crude is their biggest raw material cost. But look at Asian Paints. It is up 1.88%, leading the Nifty gainers. Why? Because the market is pricing in inventory gains. In a sudden oil spike, the paint you already have in the warehouse becomes more valuable overnight. More importantly, the smart money is betting that this spike is temporary geopolitical noise. While Asian Paint's pricing power is permanent, when a stock rises on bad news for its sector, that is the ultimate institutional green flag. It shows that big funds are using the market crash to hide in high quality cash rich companies. Stock number 2 is HDFC Life, the budget darling. The stock held green while banks crashed. What's the value motto here? Rumors are cementing that the February 1 budget will slash GST on insurance premiums from 18% to 12%. Insurance is the seatbelt of finance. If the government makes seatbelts cheaper, more people buy cars. This policy change will be a massive volume trigger. What is the strategy? This is currently in a pre event accumulation zone. The risk reward before the budget is highly favorable. Stock number 3, Bharat Electronics, the budget hedge. The data says it is up 0.55% in a bloody market. So, what is the analysis? BEL just backed 596 crore in new orders today for drone detection systems. In 2026, defense isn't just about tanks, it's about tech. With the union budget coming in February, the government's focus on Atmanirbhar defense is a green flag. Institutions like LIC were spotted buying the depth in PSU Jains today. BL is holding its 50-day EMA like a rock. Now let's look at the 5,400 crore BHEL and BEL wins in this context. BHEL, coal to chemicals. With oil prices surging, India's coal to chemicals project with Coal India is no longer just a green project. It's an energy security mandate. If oil stays above $60, converting domestic coal into chemicals becomes significantly more profitable than importing oil based feedstock. This contract is BHEL's shield against global volatility. BEL, border surveillance. With tensions rising in the Middle East and the US Russia tariff war, electronic warfare and the drone detection are the highest priorities for the Indian Ministry of Defense. BL's latest 569 crore order is for the systems that are now being deployed in real time. So, what is the insight? Most people think these are just government orders number. In 2026, these are anti-inflation orders. These companies are building the infrastructure that helps India stop relying on expensive volatile imports. Let's talk about the dark horse, the cement sector. Keep an eye on Ultratech or Ambuja. Why? Because the UN report explicitly mentioned strong public investment as a driver for India's 6.6% growth. The market is ignoring this, giving you a discount entry. Part 3, the red flags and danger zones. The NBFC crisis, Manappuram and IEX, Indian Energy Exchange. Manappuram Finance crashed 7.6% today because the RBI is reportedly blocking the Bain Capital deal. The Indian Energy Exchange fell 7.2% because of the market coupling hearing delay. These are regulatory red flags. Lesson for 2026. In a high tariff world, domestic regulatory hurdles are a biggest enemy. Avoid catching the falling knives here. The IT sector rotation, explicitly TCS and HCL Tech. TCS is down 2.9% ahead of its results. The market is pricing in a muted quarter three. However, HCL Tech plus 0.94% is diverging. This is a sector rotation within IT. Investors are moving from general IT to engineering research and development. If you are in IT, you need to be in the right subsector. Trump tariff history, the 2018 inflation ghost. Why are the veterans in the market so nervous today? Because they remember 2018 back then Trump was using tariffs at the same time oil was spiking. It's the exact same playbook we are seeing on Jan 9, 2026. In 2018, the Nifty stayed sideways for months because the input costs for the Indian companies were too high. But here is the green flag for that era. The companies that survived and thrived were those with the pricing power. Asian Paints, despite the oil spike today, is still being bought by institutions because they have the power to raise prices without losing customers. History tells us in a high oil plus high tariff world, you don't buy the cheap stocks. You buy the strong ones that can pass the cost to the consumer. The 6.6% UN growth paradox. Right. If oil is at $62 and the tariffs are here, why did they even upgrade India to 6.6% today? This is the most important 3 minutes of the video. The UN report explicitly says Indian investment cycle is now independent of global stocks. We are building our own semiconductors, our own ships, and our own energy plants. The UN isn't looking at the price of oil today, they are looking at the capital expenditure of the Indian government. They see that even if oil is expensive, India has a forex reserves of $720 billion plus to handle it. This is why the green flag is still flying despite the red screen. The dip you see today is a macro panic, but the 6.6% growth is a micro reality. Let's conclude. Do not let the tariff tantrum shake you out. Have a great weekend, and remember, wealth is transferred from the impatient to the patient. Thank you so much. See you again tomorrow.